What's up, everybody? On the channel here, we typically are trying to find deeply undervalued companies that I think offer excellent risk reward where the price is just very disconnected from the intrinsic value of the business. We tend to focus on the fundamentals, and typically I'm not putting a ton of emphasis on, say, technical analysis or anything that isn't fundamental to the business. I will sometimes look at volume or short interest. It's something I like to be aware of with a stock. I'll look at the chart and I want to know what the general sentiment is, what the trend looks like, but often I'm not drawing lines on a chart. I mean, I'm aware of what a golden cross is or cup and handles or head and shoulders, bear, bull flags, all these technical patterns, but I don't put a lot of weight in any of them. I doubt how well someone can consistently use these chart signals to trade. After all, if it were the case that a charting pattern were such a consistent bear or bull indicator, then the advantage you would get out of trading with that pattern would likely already be arbitraged away by algorithms that can just detect these things much better than humans. However, with all that said, there is one price effect that is shockingly strong and shockingly consistent over time. It's not something many investors talk about, and the size of this effect is quite large with a certain subsegment of stocks. So I thought we'd take a moment and I talk with you about it today on the channel. So we're going to discuss the end of year effect or December effect, January effect. People have different names for this phenomena, but we're going to dive into the data and I'm going to show you a certain subsegment of stocks that is particularly influenced by this effect. As always, if you get value out of the video, subscribe to the channel. If you want, consider following me on Patreon. Link to that will be down below. Now, let's dive into it. First, why might there be an end of year effect? Why might stocks behave differently at the end of the year than at the beginning of the year? The answer, as you probably know, is taxes. I'm sure you've heard about tax loss harvesting at the end of the year. If you've had a bunch of gains, you want to balance out those gains. You don't want to pay taxes on them. So you might sell some of your losers to harvest the loss there. That loss will balance out the gains that you had. And on the other hand, if you have winners, you're probably less likely to sell them at the very end of the year. Maybe you'd figure, hey, if I want to sell this stock, I could just wait until January and I don't have to pay the taxes on that gain in this calendar year. So logically, it makes sense that at the end of the year, in December in particular, that you would have increased selling pressure on losers and decreased selling pressure on big winners. And then potentially in January, you might think that that could flip. Now that it's a new calendar year, maybe you have increased selling pressure on the winners and the losers, the selling pressure there has gone away. I want to show you a paper that looked at this exact phenomena. It's called a December effect with tax gain selling, and it's by Chen and Singhal. If you search for this on Google, you can find it. The paper is about 20 years old, but their results continue to hold up by people who have looked at the subsequent 20 years. The reason we're looking at this one is I just like the way that they present their data in their tables. I'm going to jump straight to the interesting bit here, to the tables of data. Now, I really wish that they put this data into some nice charts and graphs, something where we could instantly visually see the effects going on here. They don't, but we're going to talk through it. So what they did is they divided up stocks first into size deciles. So every 10%, you have your 10% of smallest capitalization stocks all the way up to the 10% of the largest cap stocks. So, your S&P 500 stocks, those are mostly going to be in the large deciles here. Now, within each decile, they divided that decile into return quartiles. So basically, were you a loser? Was your stock going down over time? Or were you a winner? Were you going up over the past 11 months? This way, we can look at the group of large cap winners or, small cap winners, small cap losers, large cap losers. And what they did then is for every month, so say, for example, for May, they would look at the previous 11 months. And based on the stock performances over those previous 11 months, the basket of all these stocks, which they were looking at stocks trading on US exchanges, they would divide them up into these size and return quartiles. And then they would say, okay, in May, if you were a large cap winner, what was your daily return, your average daily return in May? Now, if there were no tax effects and no seasonality whatsoever with relation to stocks, then you would basically expect these monthly average returns to pretty much be equivalent to the annual average return. And what we observe is, let's just start with the large cap winners here. The large cap winners, if you look at the returns January, February, March, pretty much all the way until you get to October, returns are roughly in line with the average. But then in November and particularly in December, the large cap winner firms have outsized performance. In December, they have roughly 0.1% daily average return, which might not sound like much, but when you figure for the month, that's a 3% return. 3% return for a month is massive. Annualized, you're talking about 40% return there. This is about 4 times the daily return that's averaged throughout the rest of the year. Now, interestingly, January does appear to be a bit low. January returns are below average for the large cap winning stocks. They're not negative though, it's not anything dramatic, it just looks like below average returns. Large cap losing stocks on the other hand, so these are big companies that have gone down over time, they don't have outsized performance in December. On the other hand, they seem to have their best performance in January. In fact, the average daily performance of the large cap losing stocks in January is greater than the daily performance of those large cap winners that we just looked at in December. Now, I think that data is interesting enough already, but where you really start seeing a huge effect is in this subsegment of stocks, small cap stocks. Let's look at small cap losers. The seasonal effects here are absolutely massive. Small cap losers as a whole, if you're a small market cap company and you have been down quite a bit in price, then that basket of stocks tends to continue falling in price through the entire second half of the year. They average negative daily declines for every single month in the second half. And if we look at December, December has the largest decline here. Down on average 0.2% every single day for the basket, that is a massive drop. But then in January, for this time period, if we just look at the smallest decile of stocks with the worst returns, that group averaged a 1% daily return in January from, again, 1963 to 2001. A 1% daily return in January correlates to an over 30% return in the month. And this is averaged across this entire group of stocks over 40-ish years. That is an absolutely massive return. And if we look at the next table, which is daily turnover by month, we just see more evidence for why this effect exists. Going back to those large cap winners, daily turnover, it's lower in December than it is for most of the rest of the year. And that makes sense. If you own some stock in the S&P 500 and it's gone up a bunch, you're less likely to sell in December. There is less selling going on here. There's going to be less turnover of those stocks. As soon as January hits, turnover is a bit higher. I mean, these aren't massive differences, but yeah, turnover of those large cap winners in January, a bit more than the average. If we go and look at the small cap losers again, turnover in December, huge turnover in the last month of the year for the small cap losers. Tons of people selling small cap losers in December and then possibly, buying them back in January and February. And while again, this paper was looking at data that's mostly over 20 years old, the results have been consistent over time. The results vary a bit from year to year, but most other papers, here's another one, find the effect of tax loss selling by institutional investors on turn of the year returns is economically significant. And this paper was more focusing on institutional investors. They once again found that the effect was larger in small cap stocks. But all of this probably leads us to the question of, okay, fine. If we think that there's an effect, if we think that there's a December effect, a January effect, what does that mean for how we invest? And for me, I don't often like to time my trades too much. The effects we looked at are averaging over large number of stocks. For any individual stock, the result might be very different. This phenomena to me is something that I just want to keep in the back of my mind and possibly use it to tilt my investing strategy slightly around the end of the year. Typically, if there is a stock and I think it's offering excellent risk reward, I like to just buy. I almost never buy a full position right away. Fiserv, for example, we bought at $65 a share. It went down. We bought at $60 a share. This is not a full position for me yet, and I have no clue where the bottom is. Will this go into the 50s? Yeah, maybe. It's not even 10% away from there. Cheap can always get cheaper. Stock prices can go much lower or much higher than a lot of investors realize. But just to give an example of a stock that we talked about in the previous video, Gambling.com, this is a company, obviously the stock is down a ton. It's a small cap, under 200 million market cap right now. So this is without a doubt a small cap loser. Now, full disclosure, I own the stock in my portfolio. As always, nothing here is advice to buy or sell any stock that we talk about. But for me, keeping in mind this end of year effect around small cap loser stocks, this is not a full position for me. I expect there to be a lot of tax loss selling pressure on a stock like this. I have no reason to believe that December is going to be an incredible month for Gambling.com. Still, I owned a very small position before the drop. When it dropped, I added more. I thought it was offering good risk reward. I've explained why in previous videos. And, at the end of this month, at the end of December or beginning of January, if the price is offering good risk reward, I might be looking to add to my position here. I'm not going to completely time trades around this end of year effect, but it is something I'm going to keep in mind. And if I want to add to this position, which right now it's still a relatively small holding, it's not a full position size, I might decide to do that at the beginning of January. Regardless, I think that this is a phenomena and an effect that investors should at least be aware of, especially considering how pronounced the effect is for small cap stocks in particular. So with that said, I hope you got value out of the video. If you did, subscribe to the channel. Let me know if tax loss selling has affected your personal investment decisions. I'm definitely interested to hear about that. If you want to support what I do, consider following me on Patreon, and I hope to see you all in another video.